Hello and welcome to our spring update with the rating agencies on this, the first day of spring. I'm Jim Landman of Kaufman Hall's Thought Leadership Group, and I have just a couple of items to note before we begin the webinar. First, we encourage you to ask questions throughout the webinar using the Q&A function on the webinar platform. We'll get to as many of your questions as time permits during the hour. Second, we are recording this webinar and will share a link with you in an email within the next day or two. Moderating today's webinar are Robert Turner, a Managing Director and leader of our Treasury and Capital Markets practice, and Lisa Goldstein, a Senior Vice President in our Treasury and Capital Markets practice and Thought Leadership Group. Joining Robert and Lisa today are Eva Bogarty, Associate Managing Director at Moody's Investors Service, Susie Desai, Senior Director at S&P Global Ratings, and Kevin Holleran, Senior Director at Fitch Ratings. We thank our panelists for taking the time to share their insights with us today, and I'll now turn the webinar over to Lisa.
Uh-oh, right off the bat, how about that? We went and lost Lisa. Well, listen, thanks everybody for joining us. We're grateful. I'm gonna jump in, and when Lisa rejoins, she can take over. We want to thank everybody for being here. We really are grateful for the participation of our panelists, and I'm glad to be with everybody here today. We have a few questions that we've been working with the panel to develop, and so with that, we'll just jump right in. On the topic of recent rating activity, Eva, why don't we start with you? As we head to the end of the first quarter, what is rating activity looking like in terms of affirmations, downgrades, and upgrades?
Sure thing. And first, thank you for having us and happy spring. And I'm sure we all couldn't be more glad that winter is over. And especially on this subject. So yes, for sure, this year, downgrades have outpaced upgrades. By a long shot, 6-1. We have had a couple of upgrades, so it's not all gloom and doom. And by far, well, I won't say by too much far, but definitely affirmations are leading the day. So I mean, I think that paints a pretty good picture of where we are right now. There's certainly considerable pressure out there. It is continuing, but you know, healthcare remains, as we see it, pretty agile as well as we see in the affirmations.
Okay. Susie, how about you?
Yes, nice to see everyone again. Thank you for having us. In terms of our rating activity, similar trends. We've had through the first 2 months and mid-March-ish, we've had about 44 affirmations, 10 downgrades to 2 upgrades. So we did have a couple of upgrades in there as well, although one of those was merger related. And we've done 11 new negative outlooks, but we've also had 2 positive outlooks. So it is more negative in terms of the rating actions that we're having. Of course, a wide swath still getting affirmed as well, and a couple of positive notes there on the couple upgrades and positive outlooks.
Kevin?
And last but not least, I hope I also want to say just thanks for having us here today. We really appreciate it. We certainly value the partnership. And let me tell you our numbers real quick. I like to say that I think that the rating story on when we look at upgrades and downgrades has been the lack of activity versus the actual activity. So just to remind everybody, last year we had 13 downgrades, 10 upgrades. So almost an even split, really. I'm not gonna get too nitpicky about that. And then year to date, 4 downgrades, 2 upgrades. And so you look at it's 2-1, but the difference is it's just 2. So, you know, we have upgrades, we've got downgrades, and I think really what shocks me or comes out to me the most is just not the sheer amount, if you will. And I didn't even bother to count up all the, you know, ratings that didn't change at all, affirmations or no change to the rating. That's the rest of the ones that we touched this year. So 4-2.
All right. Lisa, welcome back.
Sorry about that. Anything I should know, Robert? Okay.
We're finished. We covered the whole thing.
Okay.
I guess it'd be helpful to just get your sense, maybe each of you, to talk a little bit about what you see in terms of negative outlooks. Is that sort of building? Is that subsiding? Maybe just talk a little bit about what might be around the corner as you think about what's setting up. Eva, can you go first for us?
Yeah, sure. I would say it's shifting, right? Or shifting and also kind of staying the same. So we might have, we're certainly aiming to resolve any negative outlooks that have been, ongoing throughout the pandemic. And that could either be into a stable outlook at the current rating level or down a level if we've seen some degradation of balance sheet as well as operations, and we think it's going to stay that way. It could be stable at the lower level. So I think, it's a pretty dynamic, I think we're using outlooks pretty dynamically right now, and trying to, use them to indicate like that, this could be a very long tail at this rating level. And so we're going to watch it and see, but there are, maybe some signs that we could go stable in 12 to 18 months. So, that's not a numbers answer to your question, Robert, but I think that we will absolutely see more negative outlooks, kind of indicating how we expect folks to manage through the next year or two, because it is a critical time and the answers are different on how teams are expecting to manage through.
Sure. Susie, anything you'd add to that?
No, I think would be similar in terms of, we had 17% of our standalones on negative at the end of the year, 14% of our systems. And as we just talked about, we're having more, it's still a lot of affirmations, but those that, there are a fair number of outlook changes. And I think we will see probably more outlook changes just because, trends are improving, but not necessarily getting back to where we thought they might be. And we may be using those outlooks a little bit more over the next year or so, just depending on where the credit trends are headed. But do still see this as a very constrained environment. And some of those outlooks may be resolved to lower ratings. Some of them may go back to stable, as Eva mentioned. But it is a constrained environment. So I think we will probably see more negative outlooks as we go through the year.
Great.
So,
yeah, go ahead, Lisa.
So actually on that note, what does an upgrade look like today outside of a merger or a change in security? Eva, let me start with you.
I think an upgrade looks like you entered in very strong before this crisis mode, right? Or even maybe before the pandemic hit. And somehow you're in that lucky group that has been able to continue to keep expenses below revenue and continue to cash flow and hold balance sheet. So it's I think we all had two upgrades so far this year. It is certainly rarefied air, but there are definitely systems that are continuing just to, maybe reap the benefits of strategies that have been deployed over the last several years, and we're able to stay that course and really manage through this time.
Kevin, anything to add to that description?
I agree with everything Eva said. Eva, sorry, I've got to never words from me, Eva. I'm going to do this more than once, trust me. I think I might still, throw out there, say an upgrade still looks like an upgrade always did, right? If you're performing at that higher level, and we expect you to stay at that higher level of performance, that's an upgrade, sort of period, the end. And by the way, same thing for a downgrade for the most part. And all of our criteria, I don't know if anyone, has changed it during this whole COVID experience. We have not. But I tell people, generally speaking, criteria works, it's a little bit like a standard. And once you exceed the standard, that's an upgrade. Again, assuming that you expect to stay there. So until we really change criteria, I would submit to you that an upgrade today looks like an upgrade used to look like. When are you performing at the next higher level?
Yeah. Susie, anything to add?
No, I think that's right. And outside, I would say, and I can't remember if you during the question you asked that part of it, but a lot of these are also merger related upgrades.
Yeah.
When we looked at our credit rating actions even from last year, and one of the two this year is related to a merger. So that certainly still seems to be the pathway.
Got it. And then one more question on rating activity. We get this question all the time. Want to give the three of you the opportunity to answer it. Given what the industry has been through the pandemic, should we expect just a systemic everybody moves down a notch decision by each of you. Susie, do you want to start?
No, we are still not, we weren't doing that before. We're still not doing that. We're still looking at every credit as it comes in. And the only thing I will say over time is we see how credits are performing. We may see that distribution of ratings start to move in a different direction, but really over the long run, it hasn't moved overall, but you know, the portfolio of credits is also changing through mergers and whatnot, but we are not systematically moving anything down this time.
Okay. Eva?
Yeah, I totally agree. We always say on these that tell us your story. It depends on your story, right? And it still depends on your story, and everyone's managing this differently. And I absolutely agree with the distribution of ratings that, as Susie discussed, might shift over time. We've been kind of tracking our median rating regularly as rating actions happen, and we're still at A2, so that hasn't totally happened yet, but we'll be watching.
And Kevin from Fitch?
Yeah, I'll even add, like, over my dead body kind of a thing, just to strengthen the message. We get asked this all of the time, and we've answered it so many times, I don't know how else to say it. I guess on the other hand, you could look and say maybe all of us have done this on some level, right? We all have a negative or deteriorating outlook on the sector. That's as far, I think, as any of us will go when it comes to this. We're not just going to wake up one morning and say, everyone's down a notch or 2 notches and let's slap a negative on for good measure. It's never going to happen.
Got it. We get the question too, wanted to give everyone the chance to address it yet again. So
I think, I mean, one thing like that comes up always on this subject, sorry, just to add on, but is, is this cyclical? Is it secular? And I think that is what all of our kind of big conversations about what's happening here in ratings management come down to, of like, how long does this cycle last? Is it really a cycle, and where do we go from here? And that, I think, also speaks to the, what will happen with ratings distribution over time. But totally agree, it wouldn't be a one shot, one fix.
Well, so let's maybe change gears for a little bit and talk about covenants and disclosure. Question, Eva, for you. If a hospital anticipates a covenant violation, when do you want to be informed, and what would you want to know?
Everything. We want to know it all. Ideally, I think we've said it before, early and often on these issues. It doesn't mean, and hopefully, it doesn't mean an immediate downgrade. It doesn't mean an immediate ratings under review. It really depends on what the circumstances are and what the cures are and what the mitigations are. And do you have a consultant, and what have the conversations been, and where are you in your turnaround plan, and how much cash to debt do you have? All of these things factor into these discussions, but it's so much better to know early, and kind of we can work on our plan alongside you working on your plan, I guess.
Do you want to see the consultant's report?
We would love to see the consultant's report. I mean, I think one of the biggest challenges we have right now is kind of bridging conversation to actual numbers, and consultant reports really help us with that. So
that's helpful. Thank you. Susie, a question for you. Does a covenant violation result in a downgrade?
So it's the classic, it depends on the credit for sure. And I think Eva mentioned a few things that we do look at. And it really is looking at what does that covenant violation mean for the credit? So is it an event of default, or is it a consultant call-in, or is it just the first year of a 2-year measurement? So we kind of need to gather all that information, look at the the overall quality of the credit rating and the credit that we're looking at. Some of those that may be expecting to trigger something may have options for how to handle it and avoid it. We've heard of credits potentially refinancing some debt to get a springing MTI into place, and those kinds of things. So we want to understand what are, again, those mitigants. What are those things that may avoid the covenant violation? If it is going to happen, we want to start understanding, again, how much kind of liquidity is there, what's sort of the overall credit profile. Where it has really started to have some rating impact is when it is generally a weaker credit to begin with, and it's an accelerating credit situation, and it becomes very problematic. So the credit has bank agreements, or they have, and they have weak liquidity and a weak position in their market, and they just don't see, and they're not really having anything they can tell us with their negotiations with their banks, and they haven't started talking to the trustee. Those where it's moving fast on a credit basis, as well as having the covenant violation, we're seeing downgrades and sometimes multi-notch. And for others, we're getting a sense, we're having the conversations with the banks. They've pretty much signed off, but have agreed to everything, but haven't signed off. We want to just kind of understand that and what the plan is. And that may, it still may be a rating action just because, or an outlook action, because the underlying credit quality is moving in a different direction. But from a pure covenant violation, we're just trying to get a sense of what the likelihood is that something is going to get triggered. And if there is a rating downgrade or something related to that covenant violation, we also look at collateral and what might happen there on a swap. So we do look at, we have to ask, it's a number of questions that we're asking, but it is, when it moves, it's because of sort of the rating is already, the underlying credit quality is already kind of moving in a different direction, and there's not a lot of room for any kind of balance there. So it's a complicated question because it's got lots of pieces that we have to answer. But some of those things, those are some of the questions that we want to understand better.
Sure, that's helpful. Kevin, I guess from your perspective, as you're seeing clients, working through this, what kinds of experiences are they having with banks? Are you seeing banks receptive to waivers and amendments? Are they running into issues and securing those? What's been your experience?
No, I think generally speaking, everyone sort of understands where we are. Terry Wareham used to use the phrase unprecedented and then started saying, getting tired of using the word unprecedented because that seems to be the new precedent. And I again, we're in unprecedented times still. This is not the normal operating environment that all of the documents basically were signed off on. People understand that we've got a worldwide labor shortage right now in healthcare. We've got, generational inflation that we're still sort of working through. And I would say when organizations are running into trouble, they look like they're about to pop a covenant. And maybe Susie went through, some of them are serious, some of them are not so serious. They're in very active dialogues with their respective bondholders, be them banks or like fixed rate bondholders. And so far, at least anecdotally, what we've heard has been very receptive. I've got an issue right now where we're dealing with, I won't say the issue or exactly the situation, but they know when they close the books, they're not going to make a coverage covenant of their normal operations, if you will. And they've reached out to all of the bondholders and they say, look, we can do X, and X means liquidating some assets. We don't really want to do that. It's not good business sense. We're going to take a hit on the investments, but we could do that and make the coverage. Or if you'll give us a waiver, then we won't do that because that makes the most sense. And so they're having these active dialogues long before it takes place. And it seems like everybody is at the table. Everyone's talking about it. Everyone, I hate to say sort of gets it, but everyone gets what's going on. We're not seeing what I would call gross mismanagement that's out there where you want to really, look, I got to get out of this. I got to sock it to it. We're in a period of time that, your expense base is just under extreme duress. We will get through this, be it 1 year, 2 year, 5 years, we will get through this. I think the bondholders really are very receptive to having those conversations.
Mm-hmm. That's helpful. Eva, question for you. What do you wish clients did differently or better as they sort of summarize covenants, as they disclose covenants? Are you feeling informed? Do you wish you understood it better? Maybe just talk a little bit about that.
Sure. Sometimes feeling informed. Yes. I mean, this is unprecedented, abnormal times, we'll call them, where there is kind of a laser focus on covenants and the high probability that more will miss covenants than usual, obviously. So, what's our dream state is, post your MTI and your bank covenants with calculations and bridge the difference between the calculations, explain them, and if you don't post them, then share them and have them handy. That's dream state, but obviously we understand everyone's managing in a different environment with different documents and there's been certainly a high degree of turnover in hospital administrations as well as, you know, in the clinical staff. So we get it. So if not the dream state reporting, then, you know, kind of open conversations as we discussed earlier is the ideal.
Okay, Susie, here's a question for you. When investors call you, what do they typically ask you about?
So covenants, what we just talked about, they definitely want to understand how we're thinking about any, you know, on any particular credit. The other big question that comes up is just how much room are you giving a credit, or some variation of that, or what are the nuances of, you know, why did you take a credit rating action here, and what, or not even on a particular credit, but which credit ratings are you taking action on, which ones are you putting outlooks on, just getting a better feel for that. Because everyone's coming in with, you know, like everyone's still showing not great numbers. So why are some kind of going through with an affirmation? Why are some, you know, having a negative outlook or a downgrade? So just getting a sense of that. We're still getting questions on debt issuance and capital spending. You know, a lot of specific sort of challenged credits that we can all probably rattle off. And then the other big question we always get is, you know, are you changing your criteria? And we also get the one that you asked earlier about, you know, are you changing all of the ratings and doing a holistic downgrade? But
okay, I would absolutely love to maybe ask Kevin and Eva to add to this. Kevin, anything you'd add to what Susie's shared?
That's a great question. All of the above I would add to Susie's. I think I agree with everything. I get a lot of, personally, a lot of comparative questions. So you affirm this one, you downgraded this one, help, you know, walk me through that, or vice versa. You upgraded this, why? You didn't upgrade that one, why? Specific credit to specific credit, I think is the only thing I could really add to that.
Gotcha. Eva, anything you'd add?
Yeah, I mean, definitely the comparisons, definitely a lot about regional, you know, who's doing great, who's doing poorly, why did this happen in the Pacific Northwest and not in Florida or Texas? You know, a lot of the regional questions popping up, state-specific questions as well.
Great, that's very helpful. Kevin, question for you. If a client adds a mortgage to their security package, do you view that as favorable to the rating?
Really has zero impact on the rating, at least at Fitch. So we do not rate to recovery prospects. And look, if you're in a mortgage situation, we're already probably at single C or bankruptcy or default or something along those lines. So it helps bondholders, more power to them, but it plays no bearing whatsoever, at least in the Fitch ratings. So just to clear that up.
Got it. Thank you. That's helpful. All right, Lisa, you want to turn it back over to you?
Yeah, question, Eva, to you. What is the best way, would you say, for hospitals to prepare for their rating agency meetings?
Yeah, I mean, so many ways to answer, but like, look, we know you're busy. We totally appreciate the busyness factor. You know, providing a concise deck is amazing. You know, obviously, best case scenario. A couple of other thoughts, like don't bury the lead. If there's a story, tell the story. If there's a reason, if there's a big divergence or something changed in your strategy, tell us that. Keep all that stuff right up front. Story and strategy right up front. Let us know what has changed and why. You know, and I think the one thing that is super helpful for us is showing those trend lines, you know, and the graphics that help support those trend lines, projecting those out as much as you can. Certainly, we know there's going to be, you know, we're working with what you give us to come up with a best case scenario, a baseline scenario, and a worst case scenario. As much as you have those and have fleshed those out and assumptions around those, certainly share them. It's better if it comes from the hospital than from us, of course. Yeah, just let us know how you're stressing things. I think I mentioned before, providing EBITDA bridges, really helpful to us. That's like huge right now these days in helping us kind of figure out where you are, where you're going, And then I guess I would say, don't be shy, reach out to your analysts. If you don't know what the key topics are, ask your analysts. If you want a list of questions in advance, if whatever is going to help ease the conversation for the hospital team, we want to provide it. So start that dialogue early when we set up the call or the meeting.
Got it. Susie, over to you. Is there something that we are not covering or covering enough that we should embellish upon? And we have to ask and throw in, the current bank situation. What would you like to know in that regard?
Yeah, no, generally I would say, all of our credits that we rate are generally covering the things that we need. I will say one of the nice things that I would hope that I hope that folks continue to provide is that earnings waterfall. That one really helps to show kind of prior year to current year to budget, and what you're expecting. So a lot of you've already been doing that. It would be great to keep doing that. Go back to forecasts and assumptions around that. Again, I know we know it's tricky to get too far out, but 2 to 3 years, and right now we're back to kind of a year type of forecast. But if we can get a couple of year, 2 to 3, if that can come back. The cybersecurity, a little bit on that would be helpful too. Just really, again, because there's so much, what's sort of your insurance environment? What is the organization doing annually to make sure the board and the management team are comfortable with everything that they have covered, just because so much has been going on? What new investments are being made? How often are you testing? Just any information you can give us that makes us feel that makes us understand how you're on top of that. In terms of the bank, which is unfortunately something that is going on now, to the extent right now, we're monitoring on our, any credits that we have exposure to on SBPAs and LOCs. But if you have any exposure through lines, or even your banking agreements with a regional bank, maybe or any bank at the time, that has some exposure or some weakness, it'd be good to understand that and what that tie-up is, because it could affect liquidity. I think, like I said, we're covered kind of on the SBPAs and LOCs that we rate, because we can monitor that. But if there's any kind of lines of credit, cash investments, things that you're holding at a bank that may be in trouble, we want to know more about that. And the last thing, I guess, and I forgot to mention, is just to the extent that, with so much going on operationally, what's going on the governance and management side that makes everyone feel that what the organization is doing. Sometimes we see year-over-year losses in a particular place. We want to understand how's management and governance kind of watching that, how are they monitoring that, and how are they, able to kind of minimize the risks around that, particularly given the current environment. So, but in general, I think we get a lot in terms of strategy and all those things. Those are a few areas that, keep doing it, and maybe a little bit more in certain areas.
Got it. Thank you, Susie. Kevin, it's all about labor right now. What do you want to see regarding labor?
It's all about labor. I'll add one thing. Susie gave a great list as like a liquidity profile as well too. So how fast can you get to your investments, like a T0, T3? That's also really very useful for us. When we're talking about labor, I think several questions come up. And look, the universal problem is we're spending too much on contract labor. And by contract labor, look, I mean classic agency, I mean overtime, shift diff, traveler, the whole bit that's thrown in there. And I guess I'd look for, three or four different things. First and foremost is how much contract labor is in-house, and graph it for me. Let me see it visually. What you obviously want to see is that the number is starting to tick down. And I would submit to you that generally speaking, most people we talk to, that number is starting to tick down. So the number of units that are being used, that's sort of number one. Number two is the cost per unit. So we all heard some egregiously high rates of per hour for, usually very specific nursing subspecialties, so to speak. And we've all said these numbers a couple of times, but they're well north of $200 an hour, some into the $300 hour range. We'd like to see the per unit cost, and where is that per month? And generally speaking, what you want to see is a tick down. And I can confirm most people I talk to, it's ticked down in some cases in half of what it used to be at its peak. So those are some really good things. And then I think the last one, and I'll kind of combine it, but net leavers and net adders. So who's leaving the organization and who's coming back to the organization. Not only just a pure hire, which is a great, wonderful thing, but who did you rehire? Because that person can hit the ground, when we talk about nurses in particular, can hit the ground instantaneously because they've already had the training. Whereas a fresh-faced nurse or right out of school, unfortunately, needs a good 6 months before they hit even the med-surg floor. So those are faster, if you will, to have an impact. So those 3 or 4 things, if you want to break that last one up into 2 pieces.
Okay, certainly always a lot to cover when it comes to that topic right now.
Absolutely, it's the number one thing. And the number 2 thing, and I know you asked about labor, but the number 2 thing that I really want to hear about personally, just to throw it out there, is your negotiations with your contract and your payers. So we know the biggest, most egregious hit right now to expenses is obviously labor, and sort of the biggest thing that you can control about potentially getting a little more revenue is with those contracts with the commercial payers that are out there. So that's sort of like, if I'm going 1, 2, those are my 1, 2 blocks of questions. That's what I want to hit.
And let me ask Eva, Susie, anything else to add while we're to what Kevin said on labor or on the contracting side?
No, but I think, yeah, that contracting side is pretty important. And we're starting to hear a little bit more. I mean, still not maybe at the inflationary rates, but definitely better than the maybe 3 to 4 that we were hearing last year, a little bit more on the contracts.
I agree. Some green shoots of positivity out there on that front.
We'll take it, right? So one more question on process, and then I'll hand it back to Robert. And this is a question we also receive from our clients, and that is, as we all know, and we'll go around the horn, as we all know, each rating agency is required to review every single rating every 365 days, right? Came out of Dodd-Frank. If each of you, and we'll go around, can describe the process that your firm uses, because sometimes a client may not hear from you within 365 days. I think that would be helpful. So Eva, let me just go over to you.
Sure. I guess I would just say, if you don't hear from us within 365 days, consider it good news. No news, good news on that front. So yes, absolutely. We have we have both formalized internal reviews, annual reviews, as well as kind of informal internal annual reviews, all of which may prompt a call to a hospital if we have questions about numbers. But so we do formally every year based on audits. We are required to do a thorough review. It's comparative. It's trend-based. It looks at the whole portfolio relative to each credit relative to each other, and then determine that the rating and outlook are okay. So that does not always require a committee. It doesn't always require contact with the hospital. So as I said, no news, good news on that front if you don't hear from us. It is disclosed on our website. You can click through by sale when the rating was last monitored. So if you're curious, you can see, XYZ hospital, XYZ sale, look through to see that data last monitored. And we do that for transparency to investors. And then there are the other, normal kind of internal touch points, happily in healthcare. We have quarterly financial statements. We're reviewing those regularly internally. Those might prompt us to reach out and have a conversation, probably more so now than ever. And as well as anything in the news, any news items that might be out there, we will review internally and decide whether we need to reach out to the hospital for a conversation, or the system for a conversation. So, and all of that said, if you feel like, certainly we've all gone through the Great Resignation and have had turnover. If you feel like you want to talk to your analyst more, or then reach out. If you can always reach out probably to any of us on this call for any information, or if you have questions about any of this review cycle, we are here and always happy to talk.
Got it. Thanks, Eva. Susie, do you want to go next?
Yeah, I think it's similar. So annually we review audits, any publicly available information, other financial information is publicly available. We get alerts from Emma, DAC on all of our credits, and we monitor that, the portfolio of our credits on a 365-day basis. And when we're doing that, we'll also look at our last review and the rating, what the rating and outlook was, and what were we expecting. And if we believe all of that is kind of inconsistent with maybe what we were seeing at the last time, it may, positive or negative, it might, and also how quickly things are changing, we will likely reach out to management earlier to have a discussion, and that might prompt an accelerated review for maybe when we were typically planning to meet, as we still try to meet with management and publish every 12 to 15 months. So if we see something in our through that review process, we'll reach out. And like Eva, we're monitoring other things too. So even if we just looked at it and something else happened in the next quarter, we'll probably reach out again. So essentially, that's how we monitor the portfolio annually. And it really, provides us with those credits that we need a discussion sooner rather than later to get a sense of where the rating and outlook should be.
Got it. Okay, thank you. Kevin?
So I'm the different egg here, unfortunately. Every credit goes to a full committee every 364 days or less, period, the end. And the only thing that might be perceived as being different is something we do have a product called an RNA, Review No Action. And we won't publish that, but it's still a full committee packet. And also, as we were discussing, disclosed on our website. So I would actually say, if you haven't heard from your analyst in 364 days, I want a phone call. Because that is a shining red line that we literally never cross. It's never been crossed since I've been here. And so that just doesn't happen for us. Now, I'd love a little bit more flexibility in that, and we can talk about that a little bit later, and maybe one day we'll get that, and we can do some touches based on audits and stuff like that. But right now, current policy is every credit's touched, reviewed every 365 days or less, 364 days, basically speaking. Full committee packet.
Okay, very helpful. Thank you to all three for clarifying that.
And I think I believe on our website too, when we touched it or looked at it, you will see a date on that as well.
Okay.
Part of the Dodd-Frank.
Right, so timestamp it and the 365 starts again, or 364 starts again.
That's right.
Okay.
And leap years count too, people. Just
Yeah,
remember,
right.
those count too.
Robert, do you want to pick it up from here?
Yeah, sure. So, one thing I think we've all experienced is a lot of negative media for the hospital industry in recent months, and I guess it'd be helpful to have you share your perspectives about whether anything about that makes its way into the rating conversation. And maybe Susie, we'll get you to go first. Any comments you'd have about that?
Yeah, it probably really depends on what it is. I mean, like, negative cyber kind of things, we definitely probably reach out and call. I know there's been other things in the media, regarding, the surprise billing or the 340B program. I think we certainly we do talk about it during the meetings, and depending on what exactly it is, we may reach out, or we may just sort of wait for our annual review cycle if we think that it's something that can wait. It can't, I mean, like I said, from the cybersecurity, that could have an impact for sure. I think what it really does though, it sort of highlights kind of some of the negative things going on in the sector overall and where the sector is. So, if you're talking about surprise billing or focus on that, hospitals being aggressive about collecting money or something to that effect, sort of just kind of maybe creates the more environment where it's difficult to kind of raise prices or work on margins or those kinds of things. So it more highlights some of the things going on underlying in the sector, but it really, we do talk about it. I haven't seen it really affect a credit rating per se, and usually there's another view of things. But it is something we talk about, and I think it does highlight some of the issues in the sector that maybe make it a little bit more difficult to maybe get more future funding from stimulus funds or that kind of thing. But not maybe necessarily a specific credit issue.
Gotcha.
Yeah.
Eva, anything you'd add to that?
Yeah, I mean, I totally agree with Susie that it just kind of focuses how tough it is for the industry right now. On the regulatory front, it's very, very hard to imagine squeezing out more dollars when there's negative press about affordability and such. So I do think it's it's just an added pressure or a highlight of the constraints that unfortunately healthcare is facing today. And as far as, specific news article, I mean, we all understand media's role in the world, and we understand the difference between media and, a healthcare strategy, or, so we try not to reach out if it's not, something that is an acute situation, impacting financial reputation, et cetera.
Gotcha. Kevin, anything you'd add?
No, I mean, I have some choice words for some of the articles that are out there, but this is a PG show, so I'll keep it there, really, quite frankly. Now, it outlines, two things. The story is Hospital is Hero is over for some reason. And we're not going to get any more funding. We keep saying that. Secondly, it actually requires more work on our end. So some kind of article comes out, we have to do our due diligence. We got to pick up the phone, call so-and-so and say, hey, I just read this. Tell me why I shouldn't believe it, sort of a thing. So it's added work, it's stress. And I think both my colleagues said, I can't think of a single time where it's ever, wow, this should be rated higher, but that article came out, let's take them down. And it just doesn't happen that way, because most of these articles are written for reasons that I won't elucidate on.
Yeah. Okay. Kevin, you just released your initial medians for 2022. Any what were the key takeaways from those?
Yeah, it was just really a preview that we sent out. So when we did our medians for last year, it was based on 2021, and 2021 was a banner year for the most part for the sector. I know, hard to believe, but it really was. And almost like the first sentence of the last report was like, buyer beware. We know this is not going to stick in 2022. So when we got a meaningful bolus of comparable 6 months in, so we could do 21 into 22 compared to 20 into 21, and take a look at 23, we could take a look at those and compare, and we just wanted to see what would we see. And we saw, unfortunately, exactly what we thought. So the medians that we showed last year really were higher in comparison. Once you start adding in more of 2022 in there, that starts to degrade the margins. And I'll just give you an idea. It's about a 300-point swing downward, whether you're looking at operating margin or EBITDA margin. And unfortunately, EBITDA margin is even lower because the market's dislocated. Balance sheets kind of follow the same ilk. And I can almost guarantee, I guess I should never promise anything, but I can almost guarantee you that when everything comes in and we look at the full year to full year, it's going to get even worse than that little preview that we just put out. So that's the preview of the preview, I guess. Yes.
So one question that we got, ratings are based, I guess I said this way, medians are based on historical periods. You've got a live conversation about expectations for future performance. With such with things in so much flux, how are you taking medians with data that's, historical and sort of somewhat dated, and using those to apply them to sort of current real-time situations?
I assume you're readdressing that back to me, but I tell people this a lot. When I first started, I doing ratings 20 odd years ago, it was very common for us to grab some paper and bring in the medians with us and really use that when we were talking. We just haven't done that in a decade plus. So medians are the outcome. They are not the driver of ratings. So we have a committee. I said before, we kind of have criteria that creates a standard for what we're looking for. The standard's voted on, standard's accepted, and you're the standard. Now you're in that A category median or that A single median, whatever it might be. Not, let me look at what the median is and then say grace upon what I've got in front of me today. So again, it's the output, not the driver, at least at pitch.
That's really helpful. Susie, what would you say to add to that?
Yeah, I think just maybe a thing to add, like how we might use it is in a moment in time, right? Like we might look at, okay, how in last year, like how did you do relative to others? Like just to get a gauge of like how things were going, because you're right, using it now is very difficult because 21, as we all said, was a highlight year. So if you looked at everything now, everything would be down. But we do try to, it's a point of information, so to speak, because our criteria has certain things in there. So I think for us, it helps to maybe just say, in this particular market or this particular group of kind of credits, how did this thing do relative, or how did this credit do relative to the others in that year that we saw it? So it gives us a gauge of that, which is sometimes helpful.
Yeah, that's great.
Yeah.
Eva, anything you'd add?
Yeah, no, I would agree that it's useful in kind of relative positioning in a shifting environment. Not the 2021. I'm talking like we're trying to pull in quarterly medians, you know, and as we're going quarter by quarter, who the relative positioning and the relative of your operations, of your cash, your liquidity it's helpful to see, you know, where where you are relative to your peers in terms of cash burn or, you know, cash accumulation, if that's you're the positive story. So, you know, I kind of agree with Kevin. It's a bit of a chicken and an egg story in normal times, but I do think we are using our internally the quarterly data as comparatives a lot.
Gotcha. That's very helpful.
Just to be clear, we were not comparing 22 to 21, but we're comparing like how was 21 to 21 medians. And then I think looking at 2022 and, you know, we don't have our full medians yet, but looking at other credits and how they're performing in 2022.
Okay. Eva, Moody's recently published something on cyber security risk. So what strategies are you hearing about as you're talking to clients in rating meetings?
Sure. Yeah, and it is something we are following a lot and talking about a lot. You know, we published our heat map last year. I think we know from the heat map that hospitals have certainly ramped up cyber spending in recent years, and you know that even with that, they trail some other industries that have a high cyber hit rate and our targets, such as banking. We obviously know that the question is how much can you continue to invest in this constrained operating environment? But you know, all that is kind of backdropped to the strategies. You know, what we've been seeing, and I pulled our cyber expert in on this, is, you know, first the basic blocking and tackling, you know, multi-factor authentication, phishing exercises, etc. I think the third-party vendor verification is huge. Most of the time breaches come in through, the hackers come in through third-party parties to gain access to the healthcare system. So there's a lot of scrutiny here on third-party vendors and third-party verification. A lot of, you know, we do see folks maintaining their cyber insurance despite the increasing costs, you know, because time is money. The longer a system's down, the harder it is, the more it costs. So insurance can really play a huge factor. And then I think, you know, for us all, we see, you know, healthcare as everyone, just tabletop exercises trying to catch these and just frequent backups of information and networks are the main, you know, strategies we're hearing. It's a big concern. It continues to escalate, and yeah, it's something we discuss regularly.
Yeah. Okay. Lisa,
Just
do you want? Yeah. Go
Yeah,
ahead.
Robert, let me, Eva, just one question on this. Do you see hospitals and health systems setting up Bitcoin accounts, or is that kind of what you get through cyber insurance? So sometimes ransom, they want it in Bitcoin. Any thoughts on that?
It's not something that I've heard
Okay.
a lot of, and I think you know, it's a great question that maybe now will appear in our next cyber survey. Lisa, thank you.
Yeah. Okay. You're welcome. Okay. Okay.
You're cutting edge.
Okay.
I don't know.
Okay.
You heard.
No, I'm shaking my head. I have not
Okay.
heard that either. So no, but yeah,
Okay.
that's a good question.
Could be, right? Okay. We actually had a writing question when it comes to strategy, and I'll read it and anyone can answer. The question is, when you consider strategy, what time frame are you focused on? Is it next year's strategy, 5-year strategy? Any thoughts on how you dimension it? Anyone?
So I would just say, I feel like we talked about this, you know, in the heat of the moment a lot last year in our webinars, right? And it was very much like you've got to go with triage right now. And I do think we're out of triage mode. And Susie, I think, mentioned, we're starting to see, forward looks and forward financial forecasting come back, maybe 1 year, maybe 2. I do think strategy, I think we expect to hear all, like, yes, how are you going to manage out of this current situation the next year? What do you see for 2 years? And we are at a point where you can't stand still on strategy. And so, like, we would expect for you to be talking about 5-year, if not now, then next month, or soon.
And I think it does go to like what I think typically we see, like those bigger strategy types of things, 3 to 5 years, so, or 5-year kind of goals. And I agree, I think we are starting to hear more about that we're doing this right now from an operating standpoint to right the ship and to get things back in order. But here's our longer vision here and what we want to do and why, we need cash flow to improve. So I think that, tends to be from hospitals and healthcare systems somewhere in that 5-year range, the strategies being provided.
And I
Kevin?
think, I guess it just has to make sense. It has to make sense for your story, right? If it's just a 1 year, then why is it just why are we looking at 1 year? Sorry.
Kevin, anything to add on that?
No, I really can't add anything other than to say we like hearing about the strategy. I always tell people I'm a sucker for a strategy, and we have been so much in triage mode and save mode and very focused on tomorrow mode. Let's not lose track of strategy because I think every organization we deal with plans on being here for the long term. We not for profit, we think generation to generation, not quarter to quarter. So that means you got to be thinking about that strategy and that down the field pass, so to speak. So that'd be basketball analogy or football, right. Both actually. So we definitely want to hear about it as much as possible, but let's not lose sight of it.
Right, take it to the hoop, right?
Absolutely.
Take it to the hoop. Kevin, one thought on strategy. How do you, when you hear about a merger announcement, how do you incorporate it? When do you incorporate it? Do you incorporate it?
Yeah, at Fitch, we have a policy really to take it, all the way to the end and even beyond. And by that, I mean, we keep things separate. So the first thing you usually hear about is a letter of intent. Wonderful, great. I'm doing nothing from a rating perspective. Anecdotally, half of those don't fail to go anywhere else. The next big stage is a definitive agreement. Also wonderful, great. Even some of those get signed, don't pass. So I'll get really interested if you have a definitive agreement with teeth in it. If I back out, I owe you so much money, that sort of thing. Okay, that means it's probably going to happen. But the reality is we follow the money even post-merger. So when two people come together, I'm the bondholder, my MTI hasn't changed. Where can I go? Well, I can go to hospital system A, but I can't go to hospital system B. So we don't try and harmonize the ratings or anything along those lines. Up until the point, either A, the new system, if you will, issues debt together. Now they're inextricably linked and you can't get there. Or if they're really in that same market and they're inextricably linked together from an operation or a visualization state from the bondholders. That's a little trickier, but most people do the debt thing long before we have to start crossing that bridge. So we actually keep it separate for an extended period of time and follow the legals, we follow the documents. What remedy does that bondholder have with that piece of paper? If they can't go to both or the new parent, then we rate to what they can go to, so to speak.
Got it. Okay, helpful. Eva, Susie, anything to add on the merger front?
Very similar.
I think we may look a little bit differently. I mean, we go up to the definitive agreement. We might change the outlook at that point if we think it's going to happen. We may signal to the market through an outlook change potentially where we think the hospital being acquired or even the system that's acquiring. And then once it happens, it does, we have a criteria that we use, and depending on how those two entities are relative to the overall system, we may see some rating changes happen. So it just depends on how that group comes together and how we view it strategically. Not to get into the weeds of our criteria, but it could have some rating changes even when the obligated groups are still separate.
Okay. Eva, anything?
Yeah, no, I mean, I think I echo all of what has been said. It really depends on the paper and the docs, the legal documents, and what the group looks like. But we don't take rating action until it's really, the ink is dry.
Got it.
Yeah.
Got it. Okay. Robert, over to you.
Eva, a question for you. Are you seeing different kinds of leverage to fund capital? I guess, with issuance down in the bond market, do you see clients sort of curtailing capital? I know they are, but are they adding other kinds of leverage in lieu of bond transactions?
I think everything is on the table, certainly for discussion. We have been seeing a little bit more interest around the edges on public-private partnerships and these, energy utilization projects. So I think that, in a prolonged period of operating stress, that's kind of a natural place to look. Whether or not it's going to take the industry by storm is yet to be seen, but I think that's, kind of something we've been hearing more murmurings about that is, maybe
Sure.
it's accelerated over the last year.
Susie or Kevin, anything you'd add?
Just some sales of buildings and whatnot, maybe to fund some capital. I think folks are, those that are maybe bigger that have companies within them may be looking to give shareholder, try to divest some of that, to not maybe the whole thing, but a portion of it to raise some capital. I think those and uses of lines of credit seem to be increasing.
Yeah, Robert, a little bit of a back to the core. So like a ProMedica, they're sort of back now to being a hospital system in Toledo, and we've seen them slowly jettison off pieces to raise some capital. I think it's not an uncommon theme that's out there. How do we get back to our core just a little bit?
Sure. Susie, any comments you'd make about investment allocation? Are you seeing clients revisit asset allocation in light of a lot of volatility in the capital markets and the equity markets, et cetera?
Haven't seen too much yet. I think a lot of folks have done some focusing of that back in 2007-8 when that crisis happened. So, maybe a short-term pool and having the long-term. So we haven't seen anything yet. I think if liquidity continues to be, if there's issues with liquidity, potentially we might see a little bit of something later on in the year, but so far we haven't heard too much in terms of changes to investment allocations.
Gotcha. Eva or Kevin, anything you'd add there? No. Okay.
Nothing for me. No.
All right. Let's see. Lisa, any questions?
I guess, are we in the new normal? Are we through the crisis mode and in a new period, or is this just the normal? Any thoughts? Kind of an esoteric way to end our call today.
It's very philosophical. Yeah, I think we're certainly past talking about the microbe COVID, and COVID volumes and things like that. Are we back to normal? No. Are we in a new abnormal? I think the answer is yes. And I think that abnormal, continues to last through 2023 and probably into 2024, maybe even 2025 for certain markets. And that again is that labor issue that we're certainly battling with almost every credit.
And I think the question we're really looking at, I think that, recovery, whatever that looks like, are the margins, going to get back to what they were, right? Or are we going to settle at they'll be better than what they are now, but are we settling at something that's much lower than where we were in the past? And what does that mean for credit quality going forward?
Right. What is, I don't think we know yet what the new normal is. Like, we're in the recovery to that new normal, but we haven't seen it totally yet.
Got it. Well, thank all of you. Let me, we know how busy you are. We appreciate your time and your partnership. Robert, thank you as co-moderator. Let me turn it back to Jim. Jim, any parting instructions?
No, thank you, Lisa, and thanks again to our panelists. As a reminder, you'll be receiving a link to a recording of this webinar within the next day or two. And thank you all for joining us, and have a great rest of your day.
Thank you all.
Thanks, everyone.
Thanks.
Thank you.